Welcome to Talking Points. Today we're going to have a quick conversation on assumptions. We need to talk about some pros and cons of what those look like. This is going to be a quick 12,000 foot overview. So if you have specific questions, feel free to reach out and let me know. First things first, we have to figure out, is my loan assumable? What you do is you're going to look at the mortgage contract. You're going to look for an assumability clause within that contract. Most people don't have any idea where their mortgage contract's at. It is filed with the county. You can pull it up on Iowa land records. You can go in there and look for that assumption contract or clause on there. If you do not find that, I would highly suggest that you contact your loan servicer. That's who you make your house payment to, and ask them about the assumptions. Every single lender or investor could have some different takes on how they treat assumptions. So make sure that you're dotting your I's and crossing your T's. So the buyer basics of assumability mortgages. This is going to be the same for no matter if it's FHA, VA, USDA, and even some possible conventional with some smaller portfolio type lenders. So the buyer basics, no matter what's going to happen, the buyer's still going to have to meet some eligibility guidelines. They're going to have to qualify. The current servicer, the current person that's getting those payments or receiving those payments is going to be the one that's going to make the determination on what those eligibility guidelines look like. And a buyer is going to have the means to make sure that they can pay the difference between what the new purchase price is and what the balance owed is. So what I mean by that is if somebody's selling a house and they've got a $200,000 mortgage still left on the house, they're selling it for $300,000, that buyer needs to bring in $100,000 in cash. So now the seller basics of the assumable mortgages. Biggest thing on these is there can be some financial responsibility that follows the seller if the steps are not taken correctly. The biggest deal is going to be the release of liability will need to be filed in order to remove all financial responsibility going forward from the seller. If this document is not filed, if that new buyer goes into default, that seller is going to have an impact on their credit report. More seller basics. Closing costs can possibly be cheaper. The seller would have the option to negotiate possibly a little bit better price based on being able to offer a little bit lower interest rate on that assumability. Once again, we've already look at the assumability clause. General buyer advantages. Obviously, the buyer is going to receive that lower interest rate right away. Instant gratification. Fewer costs involved with the assumption than if you're doing a full mortgage transfer. Buyer disadvantages is the buyer is going to need to have access to some cash. Sometimes the buyers do not have access to these. So those are going to be some kind of the hurdles that's going to have to look at from a buyer's aspect. Seller advantages. The seller is going to have the ability to market that property at a below market interest rate due to the availability of assumption. May have some negotiation opportunities due to better price. Disadvantages. There may be a limited amount of pool of buyers available that have the extra cash to make that work, and possible continued liability if a release of liability is not filed. Now, when we get into VA assumptions, these are going to be a little bit more specific. So first things first, the new buyer does not need to be a veteran, but he does have to meet all guidelines and qualifications of the new lender. If the buyer is not a veteran, the seller will not get back the amount of entitlement that they have, that they are allowed from the VA to purchase properties at 100% financing. So also, this puts the seller at risk if the buyer defaults on that mortgage, because that's going to go back and it's going to be held against that buyer or the seller's entitlement. If the new buyer is a veteran, you can choose to substitute that entitlement or replace that entitlement for trade it out for the buyer and the seller. If a release of liability is not filed, any and all credit consequences will be held against that seller. Even if the release of liability is filed, but the entitlement has not been transferred, it could impact the opportunity for that seller to use their VA financing going forward. And then also any buyer would also need to pay the VA funding fee of 0.5%. Best uses of assumptions from a buyer standpoint, they're going to have to meet the eligibility guidelines because they want a lower rate, and the buyer has an abundance of cash on hand versus the price and balance due plus costs associated. Best use of assumptions for the seller. Basically, you got a seller that's purchased a home with a government-backed financing, either FHA, VA, USDA. And they probably put a minimum down payment down when they purchased it. Their equity position is not exorbitant. So they're a smaller equity position in that house. That's going to be a little bit less money for the buyer to bring in at that point in time when they take it over. Please feel free to reach out to me with any exact questions that you have. I'm happy to sit down and talk to you about this. Look forward to talking to you very soon. Have a great day. Thanks a lot.